Hi everyone, my name is Peter Pikalski. Today we'll continue with building financial model of an apartment complex from scratch. And today we will answer one of the most important questions, how much financing is needed to start the business. I've made some magic with inputs to make our apartment complex profitable. At the end of the video, you saw here losses, but I made some changes. For example, made some assumptions, created as usual some scenario that made happen our apartment complex profitable. And now let's by the way, people are always playing with inputs. They create dozens of scenarios before they launch a project. So today we'll answer the question about financing. So if you find this video valuable, you may give us a like, subscribe, share, or write a comment. You can order financial model from scratch for your unique business idea. We can help you with that. And let's talk about financing. The general rule is cash balance at the end of the period must always be positive. You must have negative values like this. If you do have negative values, this means that you don't have enough money to finance your business idea. This means that you have to find an investor or put your own money inside the project in this line, or you have to add a loan to finance these losses. So for example, let's do the manual exercise. So we just take this line, look at the negative value here, and take this value with an opposite sign, bring it here like this. So we have 69.30. So we have the cash balance equals to $18. So we don't have a cash gap here. The same exercise here. So we can just, or we can, for example, look at the maximum value here. For example, before the operating activity starts, it is 11,408. Like this. So we are taking this money out of pocket, spending them on this, and this during the investment stage. Then we start an operating activity stage. This is the moment when we start operating activity. This is the moment when we found all tenants, and we also have some operating expenses, operating losses here. So these are the investment activity expenses, and here we have operating losses that we also have to finance before we get the first profit. So what we're doing, we're just searching for the maximum value here. We can do it as usual manually, like this, or we can just take the maximum value. This is the maximum value inside this period. So this is cash balance at the weak point of our project, and then the project starts generating its own cash. And then if we go to the right, and create for equity line, we will see how much financing we need. So we need this amount of money to start the business. But also we can add, for example, we can go get zeros here, and for example we just want to add a loan in. So now let's make our story a little bit more complicated, and we will add a loan on April 22, for example, $4 million. This will be the interest rate, this will be the term. We will have no grace period for interest payments and grace and principal payments. So we added the loan here. These are the payments for the loan. So we are looking at the cash balance at the end of the period and see the cash gap here, have cash gap. So and we just add in the money in our pocket, for example, like month by month, or we can see, for example, 10, 20, let's say 10, 300. We don't have cash back. Minus 38,000, maybe like this. Minus $38,000. So here it is, and then the project starts generating its own cash. Then we go to the end of our timeline, and you can see that this is the amount of equity we need, and this is the amount of loan that we took. We can also create some simple table. Financing, equity, loan, total financing. Parameter, value. So we will just take like this. I will take the data from the table, from the total at the end. Here they are. Yep. So this is the manual story, but we can automate all these calculations. So let's just make zeros everywhere here. We don't have equity. Let me show you the way how we can automate the calculation of equity and total financing that we need. So what I will do, I will take the end operating activity, the result, plus investment activity, plus loan, minus this. Then I will extrapolate this formula to the right. Then I will add this month to make it cumulative. Extrapolate this formula to the right. Then I will find the minimum value in this file. Minimum value in this line. Then
I will go to equity to the first month, for example, press equals, then press minus, and then I will take this value with an opposite sign. So the magic will be that here we have the amount of equity we need, here is the amount of loan, and if we travel to the right inside the cash line, at the end of it, we will see 0 equals 0.
Just show you where it is. Mathematical zero when the project starts generating its own cash. And for example, we can just adjust the amount of loan. For example, we don't have loan at all. Let's say 0. Then we will need totally this amount of money. We can travel to the right, 0 here. For example, we want to take we will want to take a 12 million loan. So the majority of capital will be financed as debt. So 12 million. So then we will have equity. We will need equity like this. We will need loan like this. Let's travel. So this is this moment when the business starts generating its own cash, and we don't have cash gaps. So the process of calculating the amount of financing for the business is completely optimized. We don't have to manually put data here. And you can easily create numerous amount of scenarios playing with data and see how much money you need to start the business in this way, that way. So this is very convenient. So this was the answer to the question how much financing is needed. So the next video will be devoted to the calculation of the payback period of our apartment complex. So if you find this video valuable, you may give us a like, subscribe, share, comment, or you can order a financial model from scratch for your unique business idea. We can help you with that. So see you guys in the next videos. Thank you.